Most people's financial goals and aspirations include being wealthy. After all, it will not only provide you with greater financial stability, but will also provide you with additional possibilities. And of course, you'd have more money to spend on the items you really want to buy. However, it's not just the now that we're thinking of. We must start to think of the long term. What's up, folks? This is Capital Finance, your go-to channel for business ideas, entrepreneurship, and personal finance. Have you heard of the term generational wealth? For context, generational wealth includes financial assets, such as property, investments, money, or anything with a monetary value that you pass down from one generation to the next. And this is what we want. We want to build a wealth that we can pass on to our kids and grandkids for years to come. So, in this video, we will look at some strategies to build generational wealth from the start. If you're ready, hit that like button and let's begin. Number 1. Employ financial discipline. Discipline is one of the most essential characteristics of a millionaire. This is because achieving financial success necessitates a high level of self-control. A good education requires years of intensive study to achieve a high-paying career. Having a good education requires discipline. Alternatively, if you want to become wealthy by starting your own company, you'll need to maintain your focus on your business even when your pals are out having a good time. And the need for self-control only grows in importance when your bank account fills up. Regardless of how much money you make, it doesn't matter if you don't have the discipline to save, since you'll never be rich if you don't. Instead of investing thousands of dollars in that new sports vehicle you've been eyeing when you can drive the automobile you've had for 10 years. According to every significant financial book by a successful entrepreneur, one of the pillars of long-term wealth growth is to save money. According to CNBC, 57% of Americans have less than $1,000 in their savings accounts, and 39% have no savings. This is ridiculous. Even though saving money might be a challenge, there are several strategies that can make the process a little easier. A strategy you can utilize is making automatic deductions. Automatic deductions from my paycheck were one of the best decisions I have made to manage my finances. For the first time in my life, I could put some money away from my salary into a savings account instead of depositing it all into my checking account. In the beginning, I set aside 10% of my total taxable income in an investment account I'd opened specifically for this purpose. Over time, I've discovered that I can increase this percentage to 20% and double my savings each month. Earning extra money is another strategy to boost your savings. Unfortunately, most people's primary plan for saving money is to minimize costs, limiting their potential to save. When it comes to saving money, the first step is to focus on lowering costs. However, in reality, you could only reduce your monthly expenses by a certain amount because costs such as rent, food, and transportation will never go away. If you want to maximize your savings, you need to focus on the other half of your income statement, which is your earnings. Number 2. Put your money to work. Basically, life is a game of Monopoly. The individual who owns the most valuable properties on the board makes the most money as the game progresses, but they can be sold at the end of the game for a large sum. However, you can only buy these investments with cash, so the rich invest their money. Unfortunately, when most people get paid, they either squander the money or put it in their savings account. A savings account is a far better use of your money than a credit card or other unnecessary spending. But the trouble with this strategy is that putting money into your savings account each month will not help you accumulate more money. Even if you had $50,000 in savings, you would only earn $47.50 a year in interest because the average savings account pays just 0.09% interest yearly. This is why the wealthy make it a point to invest their money, and the earlier they begin investing, the better. As an example, consider Warren Buffett. When Buffett was just 11 years old, he bought his first stock and has since become one of the world's wealthiest individuals. Number 3. Live within your means. When most people think of the millionaire lifestyle, they conjure up images of extravagant spending on luxury clothing and sports automobiles. However, in reality, millionaires are frugal consumers who keep their expenses in check. They've amassed their fortune to avoid falling victim to the income trap. Most people begin to spend more as they earn more money. There are several reasons why a regular car may be sufficient for someone making $50,000 per year. But if you suddenly find yourself making twice as much, you may want to consider a luxury vehicle. Parkinson's law is to blame for this uptick in consumer expenditure. According to Parkinson's law, work expands to take up all of the available time to complete it. It also means that you'll only spend as much as you have on hand financially. Available does not only refer to the funds in your bank account, which is why some will go bankrupt and then some by using all of their available credit card. Because of a lack of financial oversight, this situation occurs. Schools may teach you how to calculate slope or write in cursive, but they don't guide you on setting up and managing a personal budget, which are essential life skills. In the absence of solid financial guidance from your family or friends, you are almost certain to face money management difficulties later on. Those who operate their own enterprises need to develop the practice of living within their means much more than the average person. As a business owner, you will experience both high and low points in your company's performance. In good times, it's okay to go over budget, but if you do so in bad times, your business will likely go bankrupt. Number 4. Never use your capital. At this point, we know that the rich are meticulous about tracking their expenditure. Nevertheless, their refusal to squander their money's value sets the wealthy apart from the rest of us. Because most millionaires live frugally, they previously stated that many of them enjoy spending money on luxuries, but this does not affect their wealth because they never touch the principal. Principal in financial terms is the amount of money invested. For example, if you invested $100,000 in a company paying a $2 annual dividend per share, the $100,000 you invested will be considered the principal. The $2 per share or $20,000 will be the dividend income. Spending does not affect a person's wealth as long as they do not detract from the assets that are already providing them with income. Number 5. Track everything down. If you were to ask the average individual how much money they spent on living expenses and amusement last month, they probably wouldn't be able to give you an accurate answer. You'd get the same blank face if you asked them how much money they'd saved last month. Even if 61% of American citizens don't use budgeting, a rich person would tell you that planning and controlling your spending is essential to financial success. This two-step procedure is popular among the wealthy. The first step is to figure out how much money they can expect to make in the next month. Their wage or business income will be included in this figure and any future investment income they may have. Their 20-30-50 budgeting strategy will begin with these numbers in mind. This budgeting method divides your money as follows. Rent, electricity, and groceries account for 50% of the budget. 30% of the budget is allocated to leisure activities such as dining or watching a movie. Finally, you should put away 20% of your income in a savings account. The wealthy keep meticulous records of their expenditures after establishing a budget. However, even if you aren't making a lot of money, tracking your expenditure is still crucial because it will help you create better financial habits. Because you watch Capital Finance, I'm confident that you'll become wealthy in the future. So, you'll need to be able to handle the $1 million checks you'll be cashing in the future if you want to be successful. Thanks for watching this video, folks. Don't forget to subscribe to this channel, and I will see you in the next one.